And unless they continue to invest in them, then we could be at risk of getting higher mortgage interest rates in the future, which could affect buying demand, which then could affect the pricing of real estate. What's up, guys? It's James Allen, the Out-of-State Investor, and today I'm going to give you my thoughts on if now is a good time to be buying a house and if we're on the verge of experiencing a housing market crash in 2021. All that and more coming up right now. Right now, we're living in times where there's so much uncertainty about where our economy and housing market could be in the coming months and over the next year. So I'm going to break down some of the positive and negative things that you'll want to consider before making any decisions about buying a house. And I'll also give you my personal opinion at the end of this video. So let me start this off by taking a look at what's going on right now in the housing market. So the first problem I see is some of you still haven't smashed the like button, so go ahead and do that if you haven't already done so. But in all seriousness, you see there is a few important things we really want to take a look at in order to determine the current health of our housing market. The first thing I want to talk about is our current inventory levels. You see, right now our inventory across the nation is near all-time lows. This means that there's barely enough supply on the market to keep up with the demand of the buyers. In fact, the National Association of Realtors said in their end of July reports that it showed the lowest amount of supply on the market in almost 40 years, and it's been hovering around the same levels ever since then. So for those of you who are not aware, supply and demand is one of the biggest drivers of real estate prices. So this is a big deal, and when you have a situation like this that we're in now where you have more buyers than sellers, the sellers have the upper hand, which is referred to as a seller's market. You start to have more multiple offer situations, which can result in more people paying over ask price, and sellers can start justifying bumping up their ask price since there's barely any houses on the market for the buyers to choose from. So you can imagine, with us being at the lowest supply in almost 40 years, what effect that could start to have on real estate prices. Also, to give you an idea, a balanced market is typically 4 to 6 months of inventory. Anything above 6 months is known as a buyer's market, where there's more sellers than buyers. And anything below 4 months of inventory is known as a seller's market. Well, right now, nationwide, we're sitting on about 2 months of supply, and many markets are at less than a month of inventory. So naturally, prices are going to go up at the moment despite what's going on with COVID. Okay, now let's take a look at the number of sales. The amount of homes sold started going way below the norm when the pandemic started taking place. But since about mid-June, the amount of homes sold has actually caught up and is now up 11% from last year as of October 4th. So that's another encouraging sign. On top of that, pending sales are another thing to consider to get an idea of what the coming months ahead could look like. Now, as far as pending sales are concerned, we're looking at a 26% increase in pending sales compared to last year. So the amount of home sales does not seem to be slowing down at the moment. The total amount is going down slightly, but that's because less people generally buy homes when we get closer to the winter time. So that's completely normal. Another interesting stat I saw is that over 45% of homes are coming off market within 2 weeks due to a pending status. Now, this is a 13.1% increase from last year. So the home sales are not only rising, but they're getting into escrow faster than usual as well. Now, days on market is another metric to take into account. Now, obviously, the less days on market, the more we see how strong the demand is. So you can see in this graph that for the early stages of the pandemic, we were starting to see a rise when it comes to days on market, which is not a good sign. But since about the middle of June, we've been seeing a slow and steady, consistent decline every single week with no signs of slowing down at the moment. So that's another promising sign at the moment for the short-term health of the housing market. Right now, we also have to consider the role that mortgage interest rates are playing in this market. You see, we're currently touching around the all-time lows in mortgage interest rates. And in addition to that, mortgage applications in June hit an 11-year high, and these numbers have stayed strong as of this last week, with mortgage applications up 24% since last year. This goes to show the crazy amount of buyer's demand that there currently is for the housing market, And with these low interest rates, it's been a great opportunity for first-time home buyers to get into the market, and even for people who have been waiting to trade up to a bigger house that have gained a lot of equity over the last several years. One problem I see is if mortgage interest rates start to go up again, we could start to see buying demand drop, which could have a negative effect on the housing market. Now, the Federal Reserve has told us in mid-September that based on its economic forecast, it does plan to keep the Fed interest rate at 0% from now until 2023. Now, don't get confused by that. That does not mean that the mortgage interest rates are at 0%. That's just simply the interest rate the banks get when they borrow from one another overnight. But indirectly, it still can have an effect on mortgage rates, so that's still good news to hear. However, there are bigger things we should keep our eyes on, such as mortgage-backed securities. That's what really determines the pricing of mortgage interest rates and any fees associated with getting a mortgage. You see, mortgage-backed securities are basically shares of a company whose main assets are other people's mortgages. Now, when the prices of mortgage-backed securities go down, interest rates start to go up. And when mortgage interest rates, or mortgage-backed securities rather, go up in price, interest rates start to go down. The big problem we're facing right now is when the pandemic started, we saw mortgage-backed securities take a nosedive in price, which started to have a negative effect on interest rates and any fees associated with mortgages. But the Fed came to the rescue and contributed over $1 trillion investing in mortgage-backed securities since March. They bought $300 billion of securities between March and April and have been consistently buying $100 billion per month since then. So essentially, they've kind of artificially created these low interest rates that we're experiencing today. This is kind of alarming because there's no guarantee of how long the Fed is going to continue to prop up the housing market with these mortgage-backed securities, and unless they continue to invest in them, then we could be at risk of getting higher mortgage interest rates in the future, which could affect buying demand, which then could affect the pricing of real estate. Another very important thing that's tied to this is the unemployment rate. You see, unemployment nationwide was at its worst in the month of April when we hit 14.7%. Now, since then, we have been consistently getting better every month, with September showing we're down to 7.9% nationwide. But to put it in perspective, before COVID started, we were at 3.5% unemployment back in February. So we do have a ways to go to get back to pre-COVID levels, but we're definitely starting to show some progress. At the same time, we really need to keep an eye on how things continue to progress. I've seen more and more articles about companies laying off more people. United and American Airlines furloughed 32,000 employees in the beginning of October. Allstate said it would lay off 3,800 of its employees on September 30th. Shell gas station is cutting 9,000 jobs as of September 30th. Disney announced the cutting of 28,000 jobs on September 29th. Also, the U.S. jobless claims rose to 898,000 people, which is the highest gain in the last 2 months. Now, this is people who are seeking unemployment benefits, and all of this could play a huge part in the housing market. Now, if we see a double-dip recession, it may require more bailouts by the Fed investing in more mortgage-backed securities and possibly driving interest rates even lower to prop up the housing market. The last thing we really want to consider, and what played a huge role in the 2008 crash, is foreclosures. The good news is that as far as mortgage forbearance is concerned, we just had the largest single-week drop since the pandemic started. We're now sitting at 2.97 million people in active mortgage forbearance, which means that in the last week, 649,000 people dropped off of mortgage forbearance, making an 18% decrease from last week. On top of that, Ben Grabowski, who is the data and analytics president at Black Knight, said that Americans currently have the most available equity to them in history. So even if homeowners can't make their payments, they can still sell their house and avoid foreclosure. In fact, there's only 9% of those in active forbearance that have less than 10% equity, so that's only 267,000 people. To put it in perspective, with the 2008 crash, there were over 10 million loans in foreclosure during that market crash. So all the people that are worried about a foreclosure epidemic, they might be jumping the gun. Now, I'm not saying it won't happen, but it's too soon to be seriously concerned about this. Now, one thing to keep an eye on with this is in the beginning of November, over 800,000 people are set to reach reach their 6-month limit of mortgage forbearance. So it will be interesting to see what happens once we get to November. Okay, so overall, what are my thoughts on the housing market, and is now a good time to buy a house? Well, my personal opinion is there's more positive signs than negative signs at the moment. That can definitely change depending on if more people continue to get laid off or if the Fed decides to stop buying mortgage-backed securities. But overall, right now, I'm actually optimistic for the housing market in 2021. The amount of housing supply is so low, along with the strong demand of buyers. Mix that in with low interest rates for the foreseeable future, and I think that we're going to be just fine in the housing market, especially if we can keep gradually getting jobs back. Now, with that said, it doesn't necessarily make now a great time to be buying a house. I think you really have to analyze your own situation and decide if you're planning on holding the house for a decent amount of time, or if you're planning on selling or upgrading in the next 2 or 3 years. Now, I would say if you plan on selling in the next 2 or 3 years, I might hold off for now just to see what happens for the next few months. But if you plan on holding longer, say more like 5 or 7 years, then I would feel okay about purchasing a house right now. You see, we know the future of the housing market holds a lot of uncertainty right now. It may continue to go up from here, or it may go down. We just don't know. But what we do know for sure, without a shadow of a doubt, is that right now we have some of the lowest interest rates of all time. So it's 100% worth taking advantage of that if you can. Also, if you have the money, I would try to purchase a house that needs fixing up a bit so that you can add some value and insulate yourself some more. Try to find a property that has good systems with up-to-date plumbing, electrical, roof, HVAC, but maybe it needs a cosmetic update. This will give you some extra equity that can help you avoid foreclosure if you were to maybe lose your job and you had to sell your house after the market took a nosedive. If that's not for you and you want to buy a newer updated property, then I'd recommend holding on to a good amount of cash reserves just in case. With all that said, I hope you guys enjoyed this video. Let me know what you think about the future of the housing market in the comments below. And if you want to see more videos like this, then definitely subscribe to the channel. And if you felt like today's video added some value, then do me a favor and smash that like button. And lastly, follow me on Instagram at the Out of State Investor. Thanks again for watching, and I'll see you on the next one.